For me, the catalytic capital should be focused on backing innovative strategies that have the ability to scale over time, but are yet unproven and are too early to attract large-scale asset owners.
Mobilizing the trillions needed for the SDGs means finding ways to bring more private capital into emerging markets. And that requires new models of investment, collaboration, and risk sharing. One of the most powerful tools here is catalytic capital, which can help early funds build track records, de-risk innovative strategies, and attract institutional investors. In this episode, I speak with Nicolas Muller, Managing Director at Blue Earth Capital, about how impact investing can be structured to deliver both financial performance and measurable outcomes. From first loss protection to technical assistance, Nicolas explains how catalytic finance can turn purpose into investable opportunity and what needs to change to unlock capital at scale. Let's dive right in. Nicolas, welcome to our podcast. You work at the intersection of impact and investment in some of the world's most complex markets. What does it take to build an impact investing strategy that delivers both financial performance and meaningful outcomes?
Hi, Luka, and thanks for having me on the podcast. Great question. At Blue Earth Capital, we've been focused on building strategies that can really deliver both environmental and social impact and market rate returns. And that's the basis for us of what impact investing is. Those are strategies that deliver on both aspects of financial returns that are on par with market returns and clear and measurable impact. You first start with a rigorous investment process. And in here, we apply the same investment process that traditional firms use in private equity or private credit that have been tested over multiple years, and that includes months of due diligence. We also designed and apply a well-designed impact investing framework, which we apply to all of our investments. What is important here is to continuously reassess how you're doing things and improve things. And so we work with consultants or investors, constantly improve our processes over time. This is the first step. The second step is if you invest in challenging countries, in frontier or emerging markets, you need diversification. A lot of what we build are diversified products across geographies, impact themes, but also sectors, asset classes, and structures. That provides downside protection in case you have specific macro shocks in certain areas. The third pillar for us is to have the right team in place. And so you need diversified teams that have long-standing experience in impact investing. And we also enhance this team through meaningful partnerships. One thing I'm a big believer in is the partnership we do between impact investing firms. For example, we maintain a relationship with 400 organizations like us that are impact aligned, and we partner together in transactions to ensure we maximize the success of our investments. Finally, there is no impact without measuring it. So we need to continuously measure the performance on the financial side, but also on an impact side to ensure we're delivering on what we target to our stakeholders. Here, we have a number of industry standards like Impact Frontiers, IRS Plus metrics, etc., that people can apply consistently to all of their investments.
And building on what you just said, in practice, how do you balance the often competing expectations of stakeholders? Commercial investors seeking returns, donors seeking impact, and local partners seeking scale?
That's a very good question. In order to achieve impact, you have to marry both financial returns and impact. All of the investments that I consider, they need to be a very strong correlation between the financial performance of the investment and the impact it generates. One of the pillars of our due diligence is the impact drift risk. This is a risk of an investment achieving very strong financial returns, but not delivering on the impact. These are the investments that we will typically avoid with our products. And when we look at our investments, they can only generate financial returns if they generate the impact. For example, we back banks in emerging markets, digital banks that are specifically designed to provide access to customers that are underserved or in rural areas. Those companies are building their brand around that access and that ability to provide products to the most underserved customers. It's very unlikely that those companies will change their focus in the future to target wealthy individuals. When we make such investments, we know very well that those outcomes will be correlated. If those outcomes are correlated, then you can offer what everyone is seeking, both the donors that are seeking impact and the commercial investors that are seeking financial returns. If you achieve both, you attract more and more investors and you can achieve scale. That's the basis of our philosophy.
What are some of the structuring choices that make an impact vehicle investable to mainstream or institutional investors? How do you build in protections without compromising ambition?
When you think about institutional investors, you want to show them structures that they are very familiar with. This is quite a challenging fundraising environment. Most of the asset allocators are capital constrained. They cannot make as many investments as they would like. And in order to attract them, the structure of your investment needs to remain plain vanilla. So when we structure private equity vehicles, private credit vehicles, the first step is to understand how non-impact practitioners are structuring their products and try to replicate those vehicles as much as possible. Choose jurisdictions that people are familiar with, like Luxembourg. Choose terms in terms of fund life, fees, incentives that our investors are familiar with. You do not want people to struggle on the structuring side. That's the first step. We're discussing different stakeholders, and we have catalytic investors that can provide some structuring solutions in the form of first loss protection, and that this can be very interesting. And that's something institutional investors are typically positive on if they see strategies that match what they're looking for, but still feel uncomfortable committing. Something like downside protection can be a tool to help them bridge the gap with their requirement.
It's a good segue to my next question. Where do you see catalytic capital, including philanthropic and concessional finance, playing the most effective role in unlocking private investment? Are there situations where it's overused or maybe misapplied?
Yes, for me, the catalytic capital should be focused on backing innovative strategies that have the ability to scale over time, but are yet unproven and are too early to attract large-scale asset owners. Our research indicates that a vast majority of fund managers are raising a first-time fund or a second-time fund. They're still what we call emerging managers, meaning they have a team, a strategy, they have made investments, but they don't have the track record that institutional investors are looking for when they back managers. That's where catalytic capital can be quite effective in bridging that gap in the initial years of formation of a fund manager. This can be done through multiple forms. I already mentioned first loss structures. These are typically junior tranche investments where a catalytic investor will only get distributions once all the other investors, also called senior investors, receive their capital back. This is quite attractive for investors in strategies where the perceived risks are quite high. A second element that can be very attractive is technical assistance. Impact investing is complex, and there are increasing requirements from investors, especially in terms of impact and ESG due diligence and reporting. This can be quite daunting for new managers that often lack the capacity to meet these requirements. A catalytic investment can provide technical assistance for these managers to build the right foundations they can grow from. You then ask, are there situations where catalytic capital can be misapplied? Here we should come back to the basis of what catalytic capital is supposed to do, and it should be focused on attracting institutional capital in the medium to long term. Often, you can be tempted to back the most impactful ventures, but these might lack the commercial characteristics that are necessary to achieve the objective of unlocking private capital over time. If you think about it, concessional finance is very often a structuring tool and one that can improve the offering of a specific investment manager. One of the beliefs is you should never do an investment just because of an attractive structure. The underlying fundamental of the investments have to be strong, and the catalytic capital, the structure, should work as a multiplier of these strong fundamentals. So, to recap, catalytic capital should be used to finance attractive strategies that are still too early to attract commercial investors, but have set up the right structures, the right strategy to scale over time. And so they should avoid deep impact strategies that lack the financial rigor to scale over time.
Let's talk a little more about additionality. There's an increasing scrutiny around whether impact investments and blended structures are truly additional. How do you assess whether a transaction is mobilizing new capital or simply subsidizing the inevitable?
This is a very good question, and that's one that we are asking ourselves with every investment we complete. And here, it's important to distinguish between financial and non-financial additionality. Financial additionality is the concept of putting capital to investment that otherwise will not have been financed. This can be assessed during due diligence by, simply checking who are the other investors looking at the investment. Is the investment oversubscribed, meaning there is more demand than supply? And what are the dynamics in terms of fundraising? Capital can be specific. Financial additionality is typically achieved early on. Managers are typically raising capital over time. If you come at the first close, when managers are early on raising capital, this is typically very additional. What is also very important is the non-financial additionality of an investment. And that's when experts provide capital to a transaction, and then they provide tools that go beyond the capital. We spoke already about technical assistance. This could also be use of the network, use of your experience if you've done similar investments, or use of your name. Sometimes someone investing in a particular transaction is seen as a stamp of approval. And just because the name is there, it will attract additional institutional capital.
When investing in emerging markets and developing economies, how do you balance the risks?
Clearly, in emerging markets, you have additional risks if you invest in developed markets. Some of the key ones are currency risks. And then you also have political risks, as changes in political landscapes can have significant impact on investment outcomes. Foremost of view is that to balance the political risks that tend to be very localized, you need diversification. When you are designing an impact portfolio, it is important to build the necessary diversification in terms of country allocation. For example, most of our products tend to have a max allocation to a specific country of 5 to 10%. In terms of currency risk, you have different sectors and different investments are impacted differently by fluctuating currencies. We look for natural hedges when we complete transactions. For example, the most obvious example are export-oriented industries. Very often you can provide services or products that are provided from emerging markets and then are then sold in other countries. One good example of this is the IT industry in Eastern Europe and Ukraine. We've backed the companies in Ukraine to develop the Ukrainian economy over time and provide quality jobs in the country. Because the services are sold mostly in developed countries, the US or Europe, these companies are not affected by currency fluctuations and are resilient to shocks as the ones we've seen in Ukraine in the last few years. The other side of this bucket is, for example, real estate. If you build buildings in emerging markets, typically you will import some of the raw materials from overseas in hard currency in US dollar, and then you will sell the building locally in local currency. In that case, you are negatively impacted by fluctuating currencies, and that can have a significant negative impact on your USD returns.
What are the most interesting lessons learned that you could share with us?
I think one of the big lessons we've been focused on in the last few years is a need for increased liquidity in impact investing. What we see is this is an emerging asset class. Most of the stakeholders have been investing largely for the last 5-10 years, and they have not yet seen the liquidity that is needed to attract more capital. On one hand, you have fund managers that are raising maybe a second or a third fund, but they still don't have the realized track record to prove that they can achieve the financial and impact targets they are promising. On the other hand, you have historical LPs, for example, development finance institutions that have been deploying a lot of capital for a long time, but have now very large books of investments, and they need liquidity to come back to continue investing in these regions. And so improving liquidity in these markets have been a big focus of Blue Earth Capital, and we've been designing strategies to accelerate liquidity in these markets. This can be done through various tools. One we are particularly excited about is the use of secondaries to accelerate liquidity for all stakeholders, and as a result, mainstream impact investing and attract new investors.
What changes in regulation, investor mandates, or donor strategy would help bring more capital into impact-first strategies in emerging markets?
One of the points I will highlight is the way foundations can change their mindset. Historically, foundations have really separated their activities between their investment activities and their grant-making activities. On the investment side, most of the foundation still invest in traditional non-impact strategies, seeking the highest returns, using the profits for catalytic initiatives, philanthropy, etc. We believe this mindset needs to change, and foundations should, transfer most, if not all, of the impact investing of the investing activities towards impact investing. And as such, they can have positive impacts on both sides of the equation. This is something the Simon Wittelsbach Foundation has done, and 100% of the investment activities are via impact investing strategies. We are trying to push all the foundations across the globe to follow a similar strategy because it will unlock billions of capital with that simple shift.
What should happen to facilitate that process, the transition, in your opinion?
It's about educating foundations that they can achieve the same returns with impact investing. This is something, with Blue Earth Capital, we've been trying to prove for the last decade. And that's by focusing on investment strategies with market returns. The return targets of our products are aligned with non-impact strategies. If people believe they can achieve market returns with impact investing strategies, asset owners that have a mission to generate impact, like foundations, should have no reason to keep investing in non-impact strategies.
What are the most persistent myths in impact investing and in investing in emerging markets that you could dispel for us?
I think one of the biggest myths in impact investing is that, this is by default concessionary capital, that by having an impact investing bucket, you're going to target lower returns. We believe this to be fundamentally wrong. And actually, we think the fundamentals of impact investing are to focus on scaling solutions to address some of the largest challenges we're facing on the planet, either environmental challenges or social challenges. Let me give you an example. Maybe let's speak a bit about decarbonization. If you're providing a product or a service to a business that is at the same cost that what they're currently using, but enables them to reduce their emissions significantly, you should gain market share. I think we all agree on that. And as a result, you should grow faster than the incumbent. If you apply those principles and you focus on the right investments, meaning investment that can generate impact while being cost neutral to your customers, you will gain market share faster than the industry. As a result, you will not only achieve similar returns than non-impact strategies, you will achieve higher returns. When you look at downside risks, we invest a lot in emerging markets and we try to serve customers that are otherwise completely ignored by traditional players. That could be through healthcare investments, that could be through financial inclusion, that could be through education. Very often, the solution we back is the only solution available to these customers. As a result, even if you have macro shocks, because those are essential services, those companies tend to be extremely resilient. We've seen that, for example, in our financial inclusion portfolio, where we provide basic financial services to underserved customers. Even when you have large shocks, loss rates for these companies tend to remain very low because they are the only solution available to those providers, and they have all of the incentives in the world to continue to use them.
How optimistic are you about closing the SDG funding gap through innovative financial solutions?
So the SDG initiative, we're coming close to the target date of 2030. And while it's unlikely we'll close the gap by then, I think it's important to remain optimistic about what we achieved and to look beyond 2030. I remain optimistic about more and more capital flowing into impact investing. Over time, impact investing becoming a term that will be used by all practitioners of finance because it would be logical. We've seen this shift with other parts of investing in the past. And so I'm very optimistic about mainstreaming of impact investing now. Would it happen by 2030? I'm probably less optimistic about that point.
Thank you very much.
Thank you so much, Luka, for having me on the podcast.
And that's a wrap for this episode. Thank you for listening. Next time, we'll take a closer look at blended finance, why it hasn't yet lived up to its promise, and the reforms that could finally make it work at scale. Join us then, and don't forget to subscribe to stay up to date with the podcast and new episodes. You can also sign up for our newsletter on our website. Thanks for tuning in, and goodbye from Geneva.